Where will stocks end up at the end of 2023? That's a question that no one, including myself, has any idea what's going to happen.
Mythological hero Achilles.
You can't accept that.
Okay.
But that doesn't stop us from coming up with some educated guesses.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
This video is sponsored by the Winkleplex Family Diaper Fund. You can help support me and help improve your valuation skills by signing up for my valuation course. As a thank you for subscribing to the channel, I'm offering all YouTube subscribers a 50% discount. You can find more information about that in the description down below. Also, thank you to everyone who is currently supporting me on Patreon and YouTube Premium. Someone asked for clarification on what exactly that is. Basically, it's a way for you to support me financially and get just a couple of extra perks, which include details on which stocks I'm buying for my coffee can portfolio each quarter and a monthly Q&A video. So no obligation to sign up for that, obviously, but I do appreciate all of the support. And now back to the valuation video. We can break up the S&P 500 price into two components. So right now, for example, the S&P trades at a price of about $3,800. And that $3,800 is broken further into two components. You have price relative to earnings, which at the moment is about 20 times. And then we also have earnings per share, which according to Shiller's multiple database is $193 per share of the S&P 500. So we can calculate what the S&P 500 should be trading at by taking the current price to earnings ratio and multiplying it by the current earnings per share. And indeed, we find that 20 multiplied by 193 equals 3860, which is roughly where the S&P is trading at. So if you want to know exactly what the S&P 500 will trade at the end of the year, all you need to know is two things. One, what are earnings? And two, what are the price to earnings ratio going to be? Unfortunately, neither one of those are easy to predict. In fact, it's probably a fool's errand to even try. So let's try to make an educated guess. So first, we have determining what the estimated price to earnings ratio should be. There's a very high correlation between the inflation rate / interest rates on price to earnings ratios. So generally speaking, the higher these two numbers would be, the lower price to earnings ratios would be. And in 2022 and I think 2023, the key determinant is going to be inflation. Right now, the sticky inflation rate, as shown by the Fred data, is 6.5%. So if inflation were to remain at 6.5%, what would be the appropriate price to earnings ratios for the S&P 500? And conversely, if the inflation rate were to fall and say end the year at around 2%, which is the Fed's long-term target, then what would the appropriate price to earnings ratio be? To try to answer this question, I made a regression and plotted one variable, which was inflation, and estimated what the price to earnings ratio has historically been at a given level of inflation. Of course, there are other drivers to what the price to earnings ratio is at a given time. It doesn't all depend on inflation, so this is inherently going to be flawed. But still, I think it's an informative exercise. So what I did is I basically did the regression that had price to earnings ratio on one axis, and on the other axis, we have inflation. So each year would have its own dot plot, right? So let's say the price to earnings ratio, we'll say here is 25, 20, 15, 10, and 5. And then we'll say inflation goes up to 10, got 5, 7.5, 2.5, and 0. So each year ended up with some sort of data point. So let's say we have 5% inflation and a 15% or 15 times PE. That might be one observation. And then when inflation is 7.5, historically inflation maybe is 10. And so we got all these different dots representing a bunch of different years, whatever inflation was and whatever the PE was at that point in time. So we're going to have some outliers, right? So they're just all over the board. But what the regression software does is it tries to estimate what is the best fit line. And it generally looks something like this. So the higher inflation goes on this axis, the the lower the price to earnings ratio goes. So, for example, if sticky inflation is, say, here at 6.5, that suggests that price to earnings ratios maybe should be around 15 times. And this isn't a precise number. I'll show you the actual results here in just a second. But if inflation falls to, say, 2%, now we're saying that PE ratios should be quite a bit higher. So this is definitely a major contributor to the estimated price of stocks. And then the next thing that I did is estimate what the earnings per share are likely to be at year end. And instead of using analyst estimates, what I did was I looked at the historical numbers to suggest what are some reasonable ranges for earnings to change in a given year. So for example, historically, the median earnings per share increase for the S&P 500 has been about 5%. So that is one potential scenario. A very good scenario, or like 75th percentile, earnings tend to go up by 15%. So that would be a very good outcome. And then you've got the down earnings years, which tend to occur in recession. So of all the negative earnings years since, I think it was 1960 that I looked at, about negative 14% earnings growth was what you typically saw. And then in a severe recession or a 90th percentile decline, earnings dropped by about 30%. So using those different scenarios, we can plot those earnings outcomes with the different inflation and PE estimates to estimate what the S&P 500 could be in each of those scenarios. And when we do that, this is the chart that you end up with. So here I've got the current earnings per share number, and then 131 would be what would happen if you went into a severe recession and the earnings declined in the 90th percentile, which is negative 32%. A mild recession, or the average decline in negative earnings years, was 14%, so that would be $166 at the year end. Then the median increase was 5%, which if you increased 193 by 5%, you would get 213. And then an above trend situation, again, I think this was the 75th percentile, would be 16% higher for earnings, or 224. And then on the other axis, we have the inflation rate, and that inflation rate corresponds to the estimate of PE based upon that regression. So if inflation were to fall to 0, the model estimates PEs would be 27, and if inflation remained extremely high at, say, 6.5, the model estimates PEs would fall to 14, and then you have a lot of situations in the middle. So what I'm going to focus on are what I believe to be the most likely scenarios, and that is that inflation falls to 2% by year end, and that is actually what the bond market is currently predicting. If you look at inflation break-evens for the 1 year, suggests investors think, I think it was 2.1 last time I checked, but the bond market thinks inflation is going to fall and fall rapidly. So if that were to happen, the price to earnings estimate would be about 23 times earnings. And then we can multiply that by different scenarios for earnings per share. And the two that I think would be most likely are either the mild recession or the median kind of modest earnings growth rate. So these two scenarios would put the S&P at somewhere between 3825, which is about where it's trading at now, and 4900. So the takeaway from this particular estimate is if we can get inflation to go back down to 2%, I don't think there's a ton of downside in the stock market right now. Maybe worst case scenario, you just kind of make the dividends. And best case scenario, the market starts flirting with new all-time highs. Conversely, we have kind of the worst case scenario, which is that inflation remains at the current level of stickiness at 6.5%. If that were to happen, I think the price to earnings could start to fall towards 14, and a PE of 14 multiplied by different earnings outcomes paints a pretty grim picture. So if you get a mild recession or even a median increase in earnings, the S&P 500 looks to be around 23, 28 in kind of a stagflationary environment, or around 3,000 if you get kind of a normal growth but still high inflation environment. So both of these would put the S&P 500 quite a bit lower than what it is today. And then, of course, you have everything in between, which I'm just going to highlight here with my shaded highlighter. So I think all of these scenarios are pretty reasonable to assume, again, kind of depending primarily on what inflation does for year end. I tend to believe inflation is going to end up somewhere in this range here, this kind of 2 to 3 range. And I do think the recession, if we had one, is probably going to be pretty mild. So I think this would kind of represent a reasonable box for prices. So maybe we can retest some of those past lows. But if we did that, I would be pretty confident in that I'd be a buyer at somewhere around these levels. Again, unless the data just completely deteriorates. But anyways, that's kind of my forecast, if you will. I know it was very vague, but hopefully this gives you an idea on how you could kind of think about the market and maybe even make your own forecast. What do you think would happen to inflation and earnings in 2023? And based upon those conclusions, what would the S&P 500 trade at? Let me know in the comment section if you want to let me know what your results are, what you think the market will end up in 2023 at year end. And maybe we'll even do a prize or something to the person that got closest. I don't know. That would be kind of fun. So anyways, post your comments in the comment section. And thanks for watching the video. Happy New Year to everyone. And I will see you in the next video.